Welcome, everybody. Thank you so much for joining us today. We have a jam-packed 60 minutes ahead of us. While you're waiting here, please find the chat box and Q&A box on the Zoom control panel. Feel free to communicate there with us and use the Q&A box for your questions so we can go back to them at the end. Now, we have Dan Habib here today and Scott Brixon here today, and unfortunately, Barry Habib couldn't join us. But if you don't know Dan, I just want to tell you a little bit about him. He's been an educator in the mortgage industry for over 15 years and was recently honored by National Mortgage Professional magazine as one of the top 40 under 40 mortgage professionals in the country. He was also presented with Housing Wire's Rising Star Award. And early in his career, he was a financial advisor at Morgan Stanley, where he was a member of the Barron's #1 ranked financial advisory team in New Jersey. He serves as one of the head market analysts and chief revenue officer at Highway, which is the parent company of MBS Highway List Reports and Home Report. And due to his expertise, he's a sought after speaker, and you are going to learn a ton from him in the next 60 minutes. So get your questions ready.
Yeah, and this is Scott Brixon. I was hired many years ago at List Reports. A couple of years ago, MBS Highway bought us, and as a result of that, it's been my honor to join the morning update prep call every weekday. And it's really incredible the depth that the team goes into. It's the kind of advice you can't get anywhere else, certainly not from the mass media. So excited to give you all a chance to hear from Dan and the team. Thank you.
Well, thanks for that introduction, guys. And hey, everyone, very excited to be with you. I hope that those of you that are getting impacted by this weather are faring okay. We got hit with almost 2 feet of snow where I am in New Jersey, but we're still here. And unfortunately, as Diana mentioned, my father, Barry, I'm sure many of you were looking forward to hearing from him today. As some of you may know, he's been battling cancer. Thank God he's doing good. He's in remission, but had some complications with some blood cell counts, had to go to the hospital to get some treatments and such. So he's doing well, but he wishes that he could be with us. But I'm going to do my best here in the next hour to really educate you and let you know what's happening this year, because I got to tell you, we're very excited for 2026. And the name of the presentation here today is a forecast for a strong 2026, and really how you, both mortgage professionals on the call and realtors, can make the most of the opportunity. And before we get into the forecast, I thought this was important. Many people ask me, what's the fastest way that I can increase my income? And while there's several different ways, I think one of the easiest, or one of the most effective, I should say, without spending all kinds of additional money and resources, is simply closing more of the opportunities you already have. Essentially, converting more and increasing your conversion. But the best way to do that, I think, is with trust. And if you think about your relationships, whether it's personal, whether it's business, trust is always paramount. When trust is present, things move easy, quick, there's less negotiation, there's less shopping. But when trust is not present, boy, things get bogged down, especially in personal relationships. So trust is key. And I think one of the best ways that you can be building trust right now in today's market with your customers, with your relationships, is simply with wisdom. Because you guys know it, information right now, more than ever on this planet, is everywhere. We have artificial intelligence where you can be just, it seems like you're talking to a person. You can ask ChatGPT or any of these other AIs anything, and they give you a pretty good response pretty darn quickly. So if we want to insulate ourselves, we want to separate ourselves from our competition, we need to be making sure that we are masters of our craft, that we are giving them insights and things that they can't just get with their phone. So that's hopefully a little bit of what I'm going to give you today, and what you should be getting every single day by leveraging the mortgage professional that invited you to this call, because there's some great insights and some great tools that you should be utilizing that can help you to increase your conversion and help you increase your income. So before we get into the 2026 forecast, we do one of these every single year. And I want to just show you how we did for 2025. Not to boast, because listen, we did do pretty good on some of the forecasts, but to show you our methodology and to show you that I think the way that we're looking at things and what I'm about to tell you today is got some really good reasoning behind it, and that you can feel confident in sharing this with your customers and your referral sources. So first off, the 10-year treasury, which is important for rates. And don't worry, we're going to get into how rates work today. You're going to know more than 99% of people in the industry by the time this call is over. 10 years is an important component, but so is mortgage-backed securities. We'll get into that. But last year at the beginning of the year, we said the low on the 10-year was going to be 380. We missed it by a little, but it came down to 389, pretty close. On 30-year fixed rates, we said the low for the year was going to be in a range between 5.75% and 6%. It came in a little above that, around 6.1%. The mortgage spread, which is the difference between the 10-year Treasury and 30-year fixed mortgage rates, meaning how much higher is the 30-year fixed mortgage rate than the 10-year. At the beginning of the year, this started at 280. We said it was going to come down and compress to 2.25, and it actually came down right to 220. So I'd say that was pretty much a bullseye. Home price appreciation, we were kind of out on an island. A lot of people were calling for nationwide big price declines. We said 3.5%. And again, this is a nationwide number. I know parts of the country, depending on inventory and such, might have had small price declines. Some had, especially the Northeast, stronger appreciation. But according to Pulseonomics, which is the top 150 economists out there in the country, we partake in that survey. That's the one that we've won 4 Crystal Ball Awards from. They said it was 3%. So pretty close, but we were a little bit on the high end. And the unemployment rate we nailed. We said we were going to get to 4.5%. Boy, not even one Fed member had 4.5% in their forecasts, in their summary of economic projections. And that's what we got. So let's get into 2026. As I said, I think this is going to be a really good year. There's going to be a lot of opportunity, but we need to make sure that we make the most of it. And you have to make sure you're doing certain things right now. So inflation, always a critical part of mortgage rates and in turn, demand for you in real estate. Now, inflation is something that you feel when you're going to the store and you're buying goods and services. And boy, we know prices have gone up. But what we're talking about here is the rate of change. Cumulative inflation is a real thing. The inflation from the last 5 years, that is still there. So when I talk about inflation coming down, I'm not talking about prices in total or in aggregate coming down, but rather at what rate are prices going up now? Has that cooled off? Has that decelerated? Remember, the Fed's goal is to see prices increase, but to only increase by 2%. In fact, you don't necessarily want to see deflation because the only times in history where you've seen inflation numbers turn negative is during deep and ugly recessionary periods. So the Fed's target, as I mentioned, is 2%. There's a few inflation reports out there, but their favorite one is personal consumption expenditures. And I want to just explain to you for a second why this is important, not just because you and I feel inflation, but why it's important for rates. You see, if somebody's putting out a loan, they typically want to make a real rate of return. So let's just say that they want to make a 3% real rate of return, but if inflation, which is going to be eroding that real rate of return, is at 4%, well, they have to then charge a rate of 7%. But if inflation were to come down to, let's say, 2%, well, to still get that same 3% real rate of return, they can offer a rate of 5%. So if inflation goes higher, you have no choice but to raise rates. That's the only way that you can combat that faster pace of erosion due to inflation. Because remember, the holder of a mortgage, they're getting that same fixed rate of return over 30 years. But if inflation comes down, you always see mortgage rates come down as well. So the Fed, they follow personal consumption expenditures, or PCE, and they look at the core rate, which strips out food and energy prices. Even though that's important, they want to look at what they can control. As we're seeing right now, you could have geopolitical things happening out there where it could cause oil prices to go up and food can be impacted by weather and such. And the truth of the matter is right now, the published numbers for inflation, the headline all-in number is 2.9%. The core, which the Fed looks at, that's the one they want to see at 2%, that's at 3%. So clearly, this is above their 2% target. But there's a lot of factors that go into these inflation readings. There's a lot of components. By far, one of the biggest is shelter. Now, that's the cost to put a roof over your head. It's not home values. What it is rent, how much rents are going up, and owner's equivalent rent, how much you could rent your home for unfurnished and without utilities. And they're saying within these reports that it's going up by 3.3%. See, that's not reality. Because if we take a look at rents, you have new rents and renewal rents. New rents make up about 47%. And if we look at the latest data, real time, they're actually negative. They're down 1.3% on a year-over-year basis. Renewals make up 53%. You have a little more pricing power there. The person's already in the home. Maybe they don't want to move. Nationwide, those are going up about 3% a year. You blend them correctly together, rents are only going up 1%, not by 3.3%. Now, why is this so much higher in these inflation reports? It's because of the way they collect the data. This always lags severely behind because people aren't getting new rents every single day. Maybe they're in place for a year. They're not getting this data every single day either. So the way that this maps out is it always is on a very big lag. But you could see it's been catching up. It's been slowly going down. And we think that's going to continue throughout the year, especially with all the new rent figures coming in negative once they finally get filtered into these figures. So we think inflation is significantly overstated. And a lot of Fed members that are really harping on inflation, saying that it's way too much above target. Well, we think that shelter lag accounts for 4/10 of the 3% of inflation. And you can simply do a calculation by looking at the weighting and looking at how much they're saying shelter's going up versus the real numbers, and it's a 4/10 overstatement. But then there's also tariffs. And the tariffs, if you think of inflation as a stair step, right, as a staircase, inflation by definition is persistent and ongoing. It's not a one-time event. Tariffs, it certainly causes a one-time price increase, but then that stops. And we're actually expected to see this year all the tariff impact kind of fade away. Well, they are accounting, in our estimation, for another 4/10 of inflation. So the Fed's supposed to look through that. And you would hope they'd be smart enough to see this shelter lag. Many of them have talked about the disinflation in housing that's going to be happening this year. But if you were to say what's a real-time reading for inflation, boy, you'd have to say 2.2% is much closer to where we really are, meaning prices are still going up, but by 2.2%, not 3%. We don't think we're going to get all that catch up this year. But I do think that we're going to see inflation come down to 2.5% on the Fed's favorite gauge, which is a lot closer. It's good progress. And that's something that will help the bond market, will help rates come down. And for those of you in real estate, you know, obviously, there's a direct correlation there with rates coming down and more real estate activity. And this is a better gauge, in my opinion, of where inflation truly is. This is trueflation. They look at things, not just thousands of components out there. They're looking at millions of components every single day in real time. Doesn't have these lags. They're saying the PCE is actually at 1.5%. And another inflation reading that's very popular out there, it's not the Fed's favorite gauge, but it's called CPI, or the Consumer Price Index. They're saying is a little below 1%. So you could see where things are going to potentially be headed as these things catch up and as the tariff inflation fades. Now, the labor market is also going to be crucial for us. The Fed really cares about two main things. They have a dual mandate. They care about stable prices, which means they want to see core PCE at 2%, and they want to see maximum employment. They want to see a strong labor market. They don't want to see zero job creations. They don't want to see the unemployment rate go too high. And the labor market's so important that last year, in September, it was finally showing a lot of the weakness that we've been talking about for a long time in the published numbers, and that caused the Fed to react. Even though inflation was too high in their opinion, the labor market was showing such weakness that they wanted to get ahead of that, and they ended up cutting 75 basis points in 2025. And if you look at the Fed members today, some of them are saying, well, the labor market, it's stable. It's okay, even though we're seeing zero job creation. And one of the things they hang their cap on is something called initial claims. If you're working, you get let go, and then you want to collect unemployment benefits, you have to file for initial jobless claims, and you show up in the initial claims numbers. But we're not in the same world that we used to be in. If you file for initial claims, likely you can get maybe $400 a week provided, but that might not be enough to make ends meet. And so many people today are going into the gig economy. Maybe they're driving for Uber and Lyft, or maybe they're doing some of these food delivery services, or most likely a lot of them do a combination. But guess what? If you do that, you disqualify yourself from claims from these unemployment benefits, and you don't show up in the numbers. So I do think those figures are significantly understated. But something that's very telling within this report is called continuing claims. That's people that are staying on benefits. And the trend is that people are staying on benefits for much longer. And this number continues to rise, even though in some states you can only be on them for 26 weeks, some of them 21, and some of them 16 weeks or less. So even with people falling off of them because they're expiring, the number continues to hover around 1.9 million, and it's climbing. And what that shows you is that people are staying on benefits because there's just no hiring going on out there because it's a weak labor market. And the job openings, they've really fallen off a cliff. It peaked over here in May of 2022, but you could see how sharply this has gone down. And just in the last report, fell really sharply to 6.5 million. So not a lot of job openings out there. In fact, there's less job openings out there now than people that are unemployed. And if you look at some of the payroll data, ADP is a private payroll report. They've been showing significant weakness. The last report only 22,000. Another private payroll company, Revelio, showed in January we had 13,000 job losses. And then, of course, you have the big government BLS data. This is the one that the Fed really focuses on. And if we look at their figures, they've been weak. The latest jobs report for January, which I don't think was correct, it showed 130,000 jobs created. The market didn't even believe that. In fact, the bond market improved the next day because the numbers seem so ridiculous. But these numbers have been coming in softer, and we continue to get revisions. If you look at 2025, we only saw 15,000 jobs created per month. That's pretty much flatline job growth. Now, that's not what was initially reported, but after all the revisions begin to come in, it gets much, much, much weaker. I want to just go over with it because I think it's important, that January jobs report that we just got at the beginning of this month. The BLS said there was magically 130,000 jobs created. That's more than the 9 months combined prior. But then you had ADP that showed 22,000, and Revelio showed 13,000 job losses. And we saw 600,000 drop off in job openings. And Challenger said we had the most job cuts in that month since 2009 and the lowest hiring plans in 17 years. So clearly the BLS doesn't jive with these other labor reports. And in that jobs report, the BLS released this, and they showed that in 2025, initially they said there was 584,000 jobs created after their revisions that they do in the subsequent 2 months. Now 181,000. So that's only showing 15,000 jobs per month. And the way that this got revised is something called the QCEW. It's the actual jobs data, the quarterly census of employment and wages. Every month, the BLS does their monthly estimates, but then the BLS also releases the actual data much, much, much later. Now, we only have this data through March of 2025. So when you get the remaining 9 months revised, I think you're actually going to see a negative number for job creation when it's all said and done in 2025. But I wanted to pull this up to show you last January of 2025. Initially, they said there was 111,000 jobs created. It got revised to a negative 48,000. So they revised it down by 159,000, and they pretty much revised every single month down from last year. What do you think is going to happen to the report that we just got in the beginning of the month, where they said 130,000 jobs are created? I don't think that's a real number, but luckily the markets did see through it. But some Fed members saying, oh, the labor market now has stabilized. I want to show you how bad the BLS has been with their reporting of the numbers, or I should say how inaccurate. If we look from the latest QCEW data, which, as I mentioned, goes up until March of 2025, or through March, they did the prior year. So it's Q2 of 2024 to Q2 of 2025. The BLS in their initial report for that year period said there was 1.9 million jobs created. They do their own revisions in the subsequent 2 months, which knocked it down by about 400,000 or 1.5 million. The actual numbers from the BLS and the QCEW data show that there was only 420,000 jobs created. So that means over this year period, from their original numbers, they overstated job growth by 78%, even by their revised numbers by 73%. They missed it by that much. Now, this is likely, if you follow along with this stuff, frustrating. Because when you get these jobs reports that come out every month, if they're stronger, typically the bond market doesn't like it, rates go up, it hurts real estate activity. But then we come to find much later that they were inaccurate. And in fact, the labor market was much, much weaker. So listen, I think we're going to get into the Fed in a little bit. I think we're going to have a Fed chair that's going to be a little bit smarter to see through some of this stuff. And I do think the labor market is going to remain weak. And the unemployment rate is always one that's important. Some Fed members pointing out that the unemployment rate has recently ticked down. Listen, it's a little bit of a volatile number, but since mid-2025, it went up every single month. It's come back a little bit, but I think we're going to see that unemployment rate go up this year, probably closer to 4.6, maybe even 4.7%. If we see inflation come down slowly and moderately, if we see the labor market continue to show weakness, that in its own right is going to help mortgage rates and real estate activity, but it's also going to set the Fed up to cut rates further. Now, a lot of people get confused when the Fed starts cutting rates. I'm sure your customers, they see the Fed cut 25 basis points. Immediately, they look and they say, well, I guess that means mortgage rates are 0.25% lower. Of course, the Fed is not cutting mortgage rates. They're cutting a very short-term rate. It directly impacts credit cards, car loans, personal loans, money market accounts, short-term treasuries, things like that. but it has an indirect impact on longer term rates. But a lot of people look at this very myopically. I want to show you a chart. The blue line is the Fed funds rate. This is what the Fed controls. This is the short-term rate that they cut or hike. And then this green line is your 30-year fixed mortgage rates. And I want to go back to 2024 when they really started this cutting cycle. In 2024, remember, September 17th, they cut 50 basis points. And everybody looked at mortgage rates. And by the way, they stayed stable for 2 weeks, but then they started to rise. And everybody said, see, when the Fed cuts, it doesn't help mortgage rates. In fact, mortgage rates, they moved up. Same thing happened in November and December. But what they didn't realize is that we learned the Fed was going to cut 50 basis points ahead of that meeting, a couple of weeks ahead of that, in fact. And once we did, the markets looked forward. The markets move in advance. As soon as the market hears something's going to happen, it looks forward. And mortgage rates moved down by about 0.5% in the weeks leading up to the 50 basis point cut. So they did help mortgage rates and the 10-year to come down. And then they were stable for 2 weeks. But you can't just look at what happens after a rate cut. You also have to ask yourself, was there any coincident economic reports that were released that caused rates to move higher? Well, sure enough, on October 4th, we got that September jobs report that showed 254,000 jobs created. Now, we know now 73% of those jobs were baloney. Nonetheless, it caused rates to move higher. We saw the same thing in November and the same thing in December. If we looked at a long-term chart of mortgage rates in green and the Fed funds rate in blue, you got to see there is a very good correlation. It's not in lockstep, but typically the Fed cutting rates does help put some downward pressure on the 10-year on mortgage rates, so long as it's not perceived as inflationary and there's not coincident economic reports that can go ahead and spoil the party and cause rates to move up in their own right. So if you want to see lower mortgage rates, you want to see lower inflation, even though we don't want to root for people to lose their jobs, of course, you want to see a bit of a weaker labor market, and you want the Fed to be cutting rates. The Fed this year, they're going to have a better makeup as far as cutting rates goes, in my opinion. The Fed has 12 voting members, 19 in total. The governors and the New York Fed president always vote. And then you have 4 rotating localized Fed presidents, regional Fed presidents that vote each year. If we look at the entire makeup of the Fed this year, it leans more dovish. What does dovish mean? It means that they're more inclined to cut rates. Hawks would want to be holding rates steady, or if they see any whiffs of inflation, they're going to be more pressing to hike rates. Now, listen, I don't want somebody that's just going to be ultra dovish and somebody that's just going to say, no matter what, we're just cutting rates. You want a responsible Fed president or a responsible Fed chair. And I wish Jerome Powell, our current Fed chair, was more hawkish in 2021 and 2022 when you had the Fed cut rates to zero. You had $5.2 trillion in stimulus, and the Fed was buying $95 billion a month in mortgage bonds and treasuries. What could go wrong there? Inflation did start moving up, but the inflation readings they were looking at, mainly because of shelter, was lagging behind, and they didn't see the inflation. They were looking backward at old data instead of having the foresight to look forward, and we got 40-plus year high inflation that's still here that we're dealing with. But I think Kevin Warsh is a really good next Fed chair. He has experience on the Fed. He's smart. He reminds me of one of the best Fed chairs out there, Alan Greenspan, who had the foresight to look forward and not just at the data, but what's happening in the world and the economy. And I can tell you, Warsh is somebody that sees productivity, a lot of it due to AI, really picking up. And he has said he wants to cut rates. He thinks we can cut rates and not cause inflation to go up because of that increase in productivity. I think he's smart enough to look forward, look through some of this jobs data that's going to get revised. And I think he's going to be a responsible Fed chair. My prediction is that the Fed's going to end up cutting 75 basis points this year. Now, he comes in mid-May. So the first meeting that he presides over isn't until June. The Fed chair holds a lot of sway. A lot of times the other Fed members fall in line with that Fed chair. I think that's the first meeting where we really have a good chance of seeing a 25 basis point rate cut. So the combination of inflation coming down this year, the labor market remaining weak, and a more dovish Fed with Kevin Warsh at the helm, who I think is going to cut 75 basis points this year, I think that spells lower rates, more activity, and a really good opportunity for you in 2026. Now let's talk a little bit about real estate. You know, I like to look at supply and demand. Like any market, Supply and demand is really going to determine what happens, both with activity, both with prices, like any market. And one of my favorite measures for demand is something called household formations. So here's an example. You have a mom, dad, and child, one family living in one household. Child grows up and he moves out. It's still the same family, but you have an additional household. Or you have a married couple living together. They get separated for whatever reason. One moves out. You have an additional household formed. Demand household formations. Now, we've had, on average, over the last several years, up until 2025, about 1.8 million households formed every single year. But notice how that number really started to drop off in 2025. Well, this is exactly why you saw the median age of a first-time homebuyer go to 40 for the first time. People obviously held back. They're waiting for lower rates. Things are expensive. Well, we are seeing a lot of pent-up demand. And as soon as you see rates come down, and by the way, we're already seeing it, look at the right side of this chart, you could see that formations have already started to spike up a little bit because we've seen a period of lower rates for longer. But there's a ton of pent-up demand. But builders aren't dumb. Builders, they saw that there wasn't that many household formations. They saw that there was less demand. And what did they do? They pulled back. You could see that they were building about 1.5 million or so homes a year, 1.6 million on average. They pulled back to 1.4 because they didn't want to put all this supply out there if there wasn't demand to meet it. But now I want you to put your thinking caps on. We have a lot of pent-up demand. You have builders that have pulled back, and we have rates that are set to decline. They have been declining. We've seen relatively lower rates, and that's creating more activity, but I think they're going to take another move lower. And here we are, boy, the 10-year's at 402, which we'll take. But what this spells to me is opportunity. Because if you look at this chart, look at how mortgage rates in blue, the darker blue, and in the lighter blue, you have home sales. There's a very good correlation. But over the last few years, you've had some head fakes. Mortgage rates go down. You see a little bit of a spike. But these opportunities in mortgage rates were very short-lived. So you didn't get this big reaction that you wanted to see in home sales. Refinances are one thing. If rates drop, you get solicited or your relationship calls you, hey, you could save some money. You want to refi? Sure. But with a purchase, it takes longer. The customer has to learn that rates drop. They have to search for a home. They have to find one. They have to agree upon a contract. And all the while, rates have to remain low. You didn't really see that happening. But in 2025, we saw rates fall and remain lower for longer. And as a result, you're seeing some of the best sales numbers that we've seen in about 3 years. Affordability is at 4-year highs. So here's what I want you to think about. For your customers that are out there waiting, maybe they're waiting for rates to fall. They're already relatively lower. Do you want to be a buyer before the appreciation happens and earn that appreciation? Also, probably have a little more negotiating power, maybe some more choices. Or do you want to be a buyer after that happens and pay the appreciation and probably have less negotiating power? I think there's an opportunity right now because I do think we're going to see rates fall and remain attractive. I think we're going to see more activity. And I think you could see some opportunity for some home price appreciation in most of the country. And listen, it's hard to bet against the housing market. And this is a fun one you might want to take a picture of because, yes, there's a lot of good investments out there, but you'd be hard-pressed to find one that's done better than housing in the long run. This is an 84-year chart of home price appreciation. Home values have gone up 79 of the last 84 years. And of the years that we saw home values go down, they're all concentrated between 2007 and 2011, the housing bubble. And it could not be more different now than it was back then. Back then, no income, no assets, fog up a mirror, get approved for a mortgage. It's completely different today. Much tighter underwriting guidelines. You also back then had a glut of supply. You had 4 million existing homes for sale. Today you have like 1 million. You had builders putting up 2 million homes a year. Today it's like 1.4 million, if that. So completely different scenarios. Now I want to go over with you some forecasts because there's a lot of different forecasts out there. You have the NAR, Fannie Mae, Zillow. You could see the average of all of these different forecasts is about 2% year-over-year appreciation for the full year of 2026. Now, we're a little bit higher than that. We think 3.5%. Now, these are nationwide numbers. And by the way, if you like some of the stuff we're going over today, myself and my father, Barry, we share a lot of this stuff on social media too. I'm the Dan Habib, and Barry's is I am Barry Habib. But as far as appreciation goes, We're at 3.5% nationwide, but it is going to depend on where you're located. Your mileage may vary. And this is a very, I think, good chart for you to take a picture of and take a look at. Because what this shows you is how many active listings there are in each state today compared to pre-pandemic. So when we go back to 2019. And while I think we're going to see nationwide appreciation, in the Northeast, some of these areas have 69% less inventory than pre-pandemic. Some of them 40, 30. You can see the numbers here. You're probably going to see stronger levels of appreciation there because there's less supply. But you do have some areas where you have more supply, especially these red states. If we look at Arizona, if we look at Texas, and you look at Tennessee and some areas of Florida, of course, some of these areas in the Sun Belt and such, you have some of them a lot more inventory than pre-pandemic. You're probably going to see less appreciation in some of those areas. But in a lot of those markets, you're just giving back the greater appreciation comparatively that you saw. Because if you look at like Miami-Dade, for instance, boy, they saw like 300% appreciation. Now they're giving a little bit more back. But boy, if you look over like a 5-year period, they're still ahead compared to the rest of the country. So it's important to note we're going to see more activity. There's going to be more demand, but the supply side can impact what level of appreciation that you're going to see. Now, mortgage rates are critical. Mortgage rates, of course, if you're on the mortgage side, are important. On the real estate side, a direct correlation to activity. And Barry gets a chance to meet with some pretty special people out there. He met with Scott Bessent not too long ago and had a talk with him about the market. Scott said he wants to unfreeze the housing market. And by the way, this is our Treasury Secretary. And he has a target of 390 on the 10-year. By the way, we're not that far away here. We're about 13 basis points or so above that. Pretty good day in the bond market today. And there's a couple levers that he can pull. And there's some influences that we're going to see out there this year that we have to keep an eye on. And I think this is really important. Number one is additional debt. So the way that we as a country pay for things, I mean, we take in money through tax receipts, and then we spend more than we take in, and we deficit spend. So our debt load continues to grow. When we have a deficit, the way we come up with money is we issue treasuries, which we have to pay back with interest. Well, the more supply that goes out there, that's the more supply that has to be absorbed by the bond market, and it could have a negative impact on rates. But not all supply is created equal. If we see more short-term debt issued, it's going to have less of an impact on things like the 10-year and 30-year mortgage rates. If you see more longer-term debt issued, that's going to be more detrimental to having rates come down. So Scott Bessent has said that he wants to term the debt shorter. That means he wants to issue more short-term treasuries, short-term bills, as opposed to things on the long end. If he does that and you have less supply on the long end, that can help rates come down. Also, the Genius Act can help, especially if Scott Bessent terms the debt shorter. Now, the Genius Act is the stablecoin bill, which is in cryptocurrency world. Now, you might think I'm crazy. Dan, how the heck are cryptocurrencies going to help? Well, not Bitcoin, not Ethereum, and boy, a lot of those cryptocurrencies are taking a nice haircut, but we're talking about stablecoins here. And like the name suggests, they are stable. It is a crypto version of the dollar. It's pegged to the dollar. Everybody's trying to get in this game because it bridges traditional finance and the blockchain and crypto. The demand and the adoption is growing exponentially day by day. But how does a stable coin peg itself to the dollar? 80 to 90% of what they own is U.S. treasuries. So as that market grows, there's going to be more demand for treasuries. So that could be one big supply of demand. You also have the Fed, who's buying $40 billion a month in short-term treasuries now. That can absorb a lot of the supply out there. And something that can really help rates, remember, this is a midterm election year. Housing, a bipartisan issue. So don't think that this is probably going to be the first announcement. There could be some other X factors and wild cards out there to help housing. There's some that Barry's actually working on, being a board member of Fannie Mae. I'm not at liberty to say, but there could be some good things here in the works that are very exciting. But President Trump directed Fannie and Freddie to buy this year $200 billion of mortgage-backed securities. But once the announcement came out, you had mortgage-backed securities up over 100 basis points, but they haven't even started buying yet. They haven't released the details, but they're going to be buying this year. Just like after when the Fed had quantitative easing after COVID, and they bought mortgage-backed securities and treasuries, that helped rates artificially come down. Same thing here, except they're not buying treasuries, just mortgage-backed securities, but it will help. So I want to give you a target that we have for mortgage rates. But instead of just giving you a number, I want to take you step by step and walk you through our thinking. And I want to also explain to you, is mortgage rates, are mortgage rates based on the 10-year? Are they based on mortgage-backed securities? Which one is it? The answer really is both. Think of the 10-year as your base, and then you have the mortgage spread, which is how much mortgage rates are above the 10-year, and then you have your 30-year fixed mortgage rates. So let's walk through this. Our target on the 10-year, which right now it's right around 403, we think if we look at a chart, it can come down to some of these levels it's visited here back, in 2023, 2024, 2024, when it was at 380 briefly. And then take a look at the next level, 370, and then 360. So we think that these are all viable technical options here. But let's just go with 380 as our target. And then you have the mortgage spread. Now, why are mortgage rates higher than the 10-year? Well, one is risk, right? And one is, let's say, default risk. The 10-year is backed by the full faith and credit of the government. Mortgages, there's some default risk. But the real risk is duration risk. You see, if I buy a 10-year treasury, how long am I going to have that yield for? If I buy a 10-year today at 403, I'm going to have that for the next 10 years. That's guaranteed. If I buy a mortgage, how long am I going to get that investment from the mortgage? You can't tell me. Is it 6 months? Is it 2 years, 3 years? It depends where rates are, right? If you have a 2% mortgage rate, the duration risk is probably very low. But if you got an 8% rate, the duration risk is very high. So that is the main reason and difference between mortgage rates and the 10-year. And the mortgage spread indicates that. Now, normally throughout history, you have mortgage rates 1.6 to 2% above the 10-year. You could see how for most of history, it's in this range. But then you have periods of time where that spread really widens. You had COVID, and then you had the Fed cutting rates to zero and quantitative easing that really knocked this spread all the way down. Then you had the Fed hiking rates and quantitative tightening. Boy, do you remember back here where the 10-year was at 5% and mortgage rates were above 8%? That spread was above 3%, the difference between mortgage rates and the 10-year. But as rates come down, there's less and less and less relative duration risk, and that spread can narrow. Right now, the spread's around 190. So as we forecasted, it's been coming down. That's a good thing. And as the Fed buys mortgage-backed security, not the Fed, as Fannie and Freddie buy mortgage-backed securities, that will cause the spread to narrow additionally. So here's our forecast. We think the 10-year on the low end can definitely get down to 380. We think that the spread is going to narrow further to about 180. So you add that together, our low 30-year fixed mortgage rate forecast is around 560, but I wouldn't be surprised to see the low be 5.5 or to be 5 7/8. So I feel better giving you a range because it's hard to exactly pinpoint these things, but I think we're going to be in that range of 5.5 to 5 7/8, and that's going to open a lot of opportunity for you. Now, if we look at some other mortgage forecasts out there from some of the other players, the average is a little bit over 6%, somewhere between 6 1/8 and 6 1/4. We're okay being out on an island. It's not the first time, but as I mentioned, somewhere between 5.5 and 5 7/8 on the low side is our forecast. So if we put all this together, I think that we're going to see some lower inflation, which will help rates. A weak labor market, especially as the revisions come in and we get some more data this year, and that will help rates. I think you're going to have a Fed that's going to be more inclined to cut rates, a smarter Fed that's going to be looking forward, not backwards. And I think they're going to cut rates about 75 basis points. We think the 10-year is going to come down and the mortgage spread is going to narrow. And we think rates are going to not only remain attractive, but take another leg lower. And that's going to spell more real estate activity. And I think there is an opportunity in real estate because you're going to have an increase in demand, and builders can't just blink their eyes and create new supply, right? It takes time. They have to permit it. They have to construct it and complete it. So I think in a lot of the country, you're going to see some really big opportunities, but a lot of it's going to depend on the inventory levels, which is why I think that chart that I shared is so important. Now, I want to switch gears here and talk to you a little bit about net worth. This is always a fun exercise. And net worth, of course, is your total assets minus your total liabilities. So you might be interested to see where you may fall here. And if you want to be in the top 1% of the country, you have to have a net worth of 11.6 million. The top 2%, 2.7 million. The top 5%, 1.2 million. Top 10% is 900,000. And the top 50% is 600,000. Now, while this is, and by the way, that means half the people have more than that, half the people have less than 600,000. while this is an interesting exercise, here's what I thought was really critical. On average, 2/3 of people's net worth comes from home equity. It's very hard to get into these levels if you do not own real estate. And how about this one? Homeowners on average have 44 times the net worth of a renter. Now, I want to show you guys a couple of tools and a couple of ways that you should really be breaking things down for your customers, because you have a lot of challenges. The media certainly isn't a help. I see so many articles out there of the media saying it's better to rent than buy in every single market in the country. What's the problem? The media is only looking at the initial monthly payment differential. And there's so much more. I want to show you an example of how I would break it down, and really like a mic drop moment that you could have when somebody's asking, is it better to buy or rent? And I'm even going to skew this towards renting by putting a little bit of a higher mortgage rate than you could probably get right now. So let's just say somebody wanted to buy a $600,000 home. 10% down, the rate is 6 3/8. Their monthly payment's about $4,800 a month. Now, if they were to rent in this same market, they could find a rent for $4,000. So it's $800 cheaper every single month. But one thing you have to factor in is that renewal rents, as I mentioned, across the country, they are going up at about 3% a year. And this customer is going to be in the home for 9 years. So let's throw in some negatives that they should be looking out for. Property taxes go up. Let's put a 2% escalator. If you buy the home, you're going to have maintenance and repairs that you wouldn't have if you were renting. Let's say that's $4,000 a year. And when you go to sell the home in the future, you're going to use a realtor. Let's say there's a 5% cost to sell. But then you also have to factor in the appreciation. And the forecasted appreciation in this market is about 3.96% per year. Nothing crazy. It's actually below the average we've seen per year over the last 63 years at 4.2%. So now let's do the analysis. First, you got to look at cash flow. And this is the only thing the media looks at. Yes, it's $800 cheaper to rent versus buy at the start. But if we really dig deep here, this bar on the left is your monthly payment to buy. The bar on the right is your monthly payment to rent. You'll notice that 3% rental increase does have an impact over time. And hey, by the 8th year, it actually ends up getting more expensive to rent than own. But there's something else you have to consider. Part of your monthly mortgage payment is principal. That's not really a cost. If you look at this shaded black area on this chart, that's your principal payment. It's really like a forced savings plan. When you factor that in, it actually gets more expensive to rent in year 4. But that's just the tip of the iceberg, because after 1 year, you're going to gain $6,000 and change in principal or in equity. But then after 9 years, it's almost $73,000. And you remember that 3.96% forecasted appreciation rate? I mean, it doesn't sound that sexy, but over 9 years, it's life-changing. You would gain $251,000 in appreciation. And there's a tax benefit of buying versus renting, but you have to do this correctly. Everybody could take the standard deduction. So what is the delta versus that? Well, it's $19,000 of a benefit buying. And then, of course, the 5% cost to sell on that future appreciated value of the home is a negative $43,000. You put all this together, the media says you're $800 cheaper to rent. It's better to rent everywhere. You show somebody this. Well, how long are you going to be in the home? Are you going to be in the home for 9 years? You know, you're $255,000 better off buying versus renting. Now, if you're going to be in the home for 1 year or less, you simply can't overcome the cost to buy and the cost to sell. But anything longer than that, you're definitely better off buying, and here's why. And there's your mic drop. Now, another very big concern that I see out there, or problem that you may have, is consumers just simply wanting to wait. Maybe they hear the Fed's going to cut, or they hear rates are going to come down, and they say, you know what? I want to wait. And maybe you try to overcome that, and you might say, well, you know what? You should marry the home and date the rate, meaning buy the home today, even though rates are a little higher than you want. And when rates come down, me or your mortgage professional is going to refinance you. But unless you quantify it for them, it really just is a cute saying. So here's one of my favorite tools right now. Let me show you how I would break it down. Somebody's looking to buy a $700,000 home, either right now or let's say next year. And the forecasted appreciation in this market is 3.5%. They want to put 20% down, so it's a $560 loan amount. The current rate they could get is 6.25%, but maybe they want to wait for rates to fall 0.5% to 5.75%. So if they were to buy today with the higher rate, there's a cost of dating that rate. It's $180 a month more if you bought today. Now, if you were going to hold on for a year and then refinance to the lower rate, you would pay that $180 every single month. So over the next 12 months, your cost of dating the rate would be $2,160. And then when we do refinance you, there's a cost for that. It's $4,000. So the cost to date the rate is $6,160. That's your cost of buying today versus waiting for rates to come down 0.5%. Sounds like an expensive date, right? But here's the benefit of marrying the home. 3.5% appreciation on that $700,000 home. If you bought today, you'd gain $24,500. You subtract out the cost of dating the rate, you're still better by over $18,000 buying today versus waiting. And this is the kind of stuff that an advisor puts in front of their customers. This is the kind of stuff I'd have at every single one of my listings, every single one of my open houses. And this is the kind of stuff that they're not going to be able to get from your competition out there. They'd be hard pressed to get something like this proactively from artificial intelligence. And this is something that if you're a loan officer on this call, if you're on MBS Highway, you have all of these tools and 1,000 others at your disposal that you can brand and co-brand with your real estate agents. But this is at least the strategy that I want you to take if you're not on MBS Highway. And marrying the home date, the rate has been a good strategy because we've seen good appreciation and there have been refinance opportunities. But the problem is they've been very short-lived. I mean, you have maybe a couple of weeks, a couple of days, a day, maybe a week and a half, a day, a week. You've had very, very short opportunities, which is why, as a mortgage professional, you need to make sure you're proactive and you're staying on top of this and you're establishing a strike rate with every single one of your customers. And what that means is let's say the customer is at, I don't know, 6.75%, and you come to an agreement and you say, listen, the opportunity may be fleeting, but when we hit 6%, we're going to refinance you because if we sleep on this, the rate may just move higher. We don't know how long the opportunity is going to last. And you want to get a commitment from them, and you don't want to be reactionary. I can't tell you how many mortgage professionals I talked to that did not maximize the opportunity over the last 2 years or so when there were, because they waited for rates to come down. They reached out to the customer. By the time they got a hold of them and explained this, rates already moved away from them. So we try to help you at MBS Highway, if you're a mortgage professional, to really maximize the opportunity that we see ahead. And even right now, by putting all of your transactions into our strike rate tool, you set the thresholds and we send you alerts as to when your customers are in the money to go ahead and refinance so you don't miss any of these and so you can capitalize to the highest degree. And if you have our home report tool, which I'll go over, we not only show you rate savings, but we also show you if there is an MI reduction or removal savings as well, since we're pulling the value of the home, which nobody else does. So you really will be on top of your database and know when the best times to refinance your customers are. Now, guys, you need to make sure you are sending something out to your customers on a regular basis, something that is engaging. It's a non-negotiable in today's market. And you want something that is going to get high engagement, but also where people are going to be reaching out to you and people are going to be interested in refinances, interested in moving. And that's really what we've created with our home report tool. Now, I believe all of you guys are on list reports, so you're familiar with how the pairing model works and how all the marketing kits work on there. Think of this as unlocking another marketing kit within list reports. It's free for agents. Unlike some of these other services out there where the agent has to pay, the LO has to pay, you add more people, I mean, you're paying a ridiculous amount of money a month. Our service is free for agents, just like list reports. The mortgage professional has to sign up, but boy, what an amazing tool to keep in touch with your database, to know what they're looking at, to know when they're ready to move, when they're ready to refinance, and to make sure you're there for the next opportunity. And it's a fraction of the cost of anything else out there because it's not our only product and it's in our ecosystem. So I want to actually just show you what it looks like live on the site here, because it's really my favorite tool that we have going right now, just because it's so easy to use, it's so impactful. And here's what it looks like. So the customer every single month will get a home report for their property. It'll show what the current value of the home is. And it'll show when they purchased it and what it's worth today. So boy, this customer, they purchased a home a couple of years ago. They've gained $88,000. And then we show what the future looks like, which nobody does, because we have the forecasted appreciation for every single market. We also even now have some cool games embedded that will show listings in their area. They have to kind of guess the values of the games, but it also can get them interested in homes in their area, but also great for engagement. But this is one of my favorite pieces here. It's the readiness to move score that the customer indicates. So the customer can tell you, hey, I'm ready to move right now. And all of this has great reporting on it. So I'm going to get an alert now, as well as the realtor. Hey, we saved your rating and let Joe and the realtor know here. You should get in touch now. So you'll know exactly what your customers are looking at on this home report and what activities they're taking. We show how much equity they have. And if I have a customer in here that's spending a lot of time looking at how to pay off high cost debts, boy, that's probably a good lead to maybe call them, do a blended rate analysis, maybe a cash out refi, maybe a HELOC. This is the most viewed part of the home report. It is the market insights. This is where we show you all the markets in the surrounding areas. The customer can add any market they want. And once they do, all of those listings are going to show below here. And then they can go through the listings and all the images and all the information right here on the right-hand side. They don't have to go to Zillow where somebody's going to try to poach them. And then you get really robust reporting on this. So think about how valuable this is as a mortgage professional, and especially the realtor. You have a customer that now you know they looked at these 10 listings in these markets at this price point, and they're ready to move right now. I mean, that's a pretty hot freaking lead. And as the consumer, they can come in here and even refine this search further, where they can set their affordability, where it's not going to show every home. It's only going to show homes that really fit their criteria. And you can see how this is co-branded with both the loan officer and the agent. And you'll see everywhere on this home report, it's designed for engagement. There's a million different ways that the customer can click to get engaged with both the LO and the realtor. And then on the tools section, this one's really cool, where we know if they have mortgage insurance, we'll tease for them how they can cancel their mortgage insurance. And consumers can say, hey, help me cancel mortgage insurance. And you can see by refining or how long it would take based on appreciation, extra payments, or if they just wanted to let it fall off automatically, how long it would take. So we really underscore how much we could save them and why they should do this. And we also know what their current rate is and what market rates are. This is also linked to the strike rate tool if you're on MBS Highway. So based on if their strike rate is hit, the language here will change. But this customer's at 7.5. Current market rates are a little above 6. Boy, this customer could save $950 a month. We're getting thousands of messages a month of consumers saying, hey, I'm interested in refinancing. That's going to their mortgage professional. And there's an early payoff calculator here as well. So it's a really fantastic tool, team. And then there's reporting on the back end here that is very robust. It's going to make me sign in. But let me just pull up for you the slide deck one more time. But the reporting will show you exactly what they're doing. It will let you know what listings they're looking at. They're ready to move. And then I want to just show you some of the, and here's what the reporting looks like here. And you can see that they looked at 3 properties, and it'll show you the properties if you drop this down. But I want to ask you, are you getting messages right now with whatever setup you're using from your past database like this of consumers saying, hey, I'm interested in refinancing? These are all people on Home Report. I saw on the refinance tool, I'm close to a potential savings. I'd like to get a full quote, discuss my options. You can see all these, a bunch of refinancing interest leads from their database. I'm using home equity to build value. I want to learn how I can pay off high cost debts. I'm interested in a HELOC. When can I remove mortgage insurance? You could see early payoff questions. I'm planning on moving in the next 1 to 2 years. I want to look at some homes. So you could see that we send thousands and thousands of these messages, but you need your database to be working for you. You need to be sending something like this that gets over an 82% engagement rate, and it's free for you, the real estate agent. But the key is, or the catch is you have to pair with your mortgage professional, which you should already be with on list reports. And listen, team, we started with this, and I want to finish with this. The fastest way to increase your income, I think, is by building trust with your relationships, your customers, your database of customers, and people that you're talking with. And the best way to do that, or at least one of the best ways, at least in my humble opinion, is by really leaving them feeling like you are a master of your craft. I mean, people are drawn to those that they feel put in the work, that they leave them feeling smarter after talking with them. Now, if some customer comes up to you and they're like, well, is it a good time to buy? And where are rates headed? And maybe you're like, boy, yeah, it's okay to buy. And boy, if I knew where rates were headed, I'd be on a beach somewhere drinking a pina colada. You might get a chuckle, but you blew an opportunity to build trust. And you really blew an opportunity to show why you're different and what your expertise is. And, you can obviously be on MBS Highway if you're a mortgage professional. I know many on this call are. And the presentation you saw today, I mean, we do that every single day. So you can be a step above your competition, insulate yourself from artificial intelligence, and it's concise. It's less than 10 minutes a day, and then your conversations are changed and your conversion increases. And if you're a real estate agent, I hope that today's presentation helps you really arm yourself with a little bit of what we expect to happen this year and some of the strategies and what you can be telling customers as to why they shouldn't be waiting and what the opportunity is. But make sure you're leveraging the mortgage professional that invited you to this call. Make sure you're paired with them on list reports. If I were you, I'd get with this mortgage professional and get on home report, because there's nothing better to send out there than this to your database to elicit a response and to be there for the opportunities that we truly feel will be there this year. Now, home report, it's normally $170 a month. For you guys, for the mortgage professionals on the call, it's less than $100 a month. It's a fraction of the other stuff out there. And again, it's free for agents. If you get one deal, you're going to pay for the service for like a year and a half, but I promise you're going to do a lot better than that as long as you upload your database in there. And everything happens automatically. MBS Highway, it's normally $200 a month. If you're on this call and you're not on MBS Highway and you want to be on it, and remember, that gives you all those tools that you can co-brand with realtors as well, like the cost of waiting and the buy versus rent that we went over. But there's a million different tools on there. You get the daily commentary. We follow the market for you, tell you when to lock and when to float and such. We discounted that down to $119.95 a month. And if you sign up for either one of these from today's call, if you sign up today, and all you have to do to sign up is let Diana know. Just email Diana at MBS Highway. She will take care of the rest for you. If you sign up for one of these today, you're going to get our certified mortgage advisor designation free of charge. Now, this is just for mortgage professionals on the call, but it's something that we sell for $2,000. It's the best education you'll ever see in the mortgage industry. It's like 8 hours of online video content. It gives you a big differentiator because you can call yourself a certified mortgage advisor, market that, but it truly is what Barry's learned in his 30 years of experience on how to be the #1 LO in the country on multiple occasions. In a course, we've gotten just rave reviews. You're going to get it for free if you sign up for one of these today. And I will go ahead and stop there. And I think there might be a couple of questions. But again, if you're interested, it's free for realtors, obviously. But if you're a mortgage professional, you want to do this with your realtor, add it to your list reports account, just email Diana at mbshighway.com.
Awesome. Thank you so much, Dan. Well done. Hopefully you all learned a lot in this call. And first things first, I'm going to go through a couple items I've been seeing in the chat. First, thank you so much for the kind thoughts and prayers for Barry. It means the world to us and, of course, the world to him. So thank you very much for thinking of him. Regarding the recording, that'll be emailed to you shortly this afternoon. So just keep an eye out for that. Feel free to share it with whomever you'd like. And then, as Dan mentioned, for agents that are asking how do you get home report list reports, just ask your loan officer that invited you here to pair with you, and you get it for free. And then regarding the other options, my email is diana@mbshighway.com. But we do have a few minutes to answer any kind of market questions. So if you're wondering on how to answer questions on inflation, the Fed, the economy as a whole, feel free to ask them now in the Q&A box.
I got to say, I'm very happy the power held out, because before this call, my power went out and it came back.
I was very nervous too. I'd see another question on the recording. That'll be emailed to you shortly. So just hang tight for that.
Thank you for the nice comments, team.
Awesome. Well, listen, if you guys have any other questions, you have my email, you know how to reach out to us. Really hope you learned a lot in today's session and have pages full of notes. And if you need anything, you just reach out. Thank you guys so much. See you soon.
Thank you guys for the prayers for Barry. Take care, everybody.